Welcome, folks. This is Abhijit Chatterjee, and with Rohan Singh, we are delighted to have you join us on the Charts Are Fun Meeting 3. Today is Friday. It's the evening of March 8th. A lot has happened this week, so really excited to get started and share some of the analysis and trends and patterns that we've been following in the markets. I do want to remind folks to please subscribe to our channel. It's youtube.com/charts-are-fun. So if you could please subscribe, it does help us with the YouTube algorithms to have more and more folks see it. And also, if you do like the videos, if you could also hit the like button, we really appreciate that. So in here right now, we have two videos for the last couple of weeks. We do it once every week. So meeting 1 and then meeting 2. And then Rohan just quickly created a shorts, and we are hoping to publish other shorts as well, taking small clips out of these videos to share some core ideas from it. Let me go full screen. It's our Charts Are Fun YouTube site and our blog site, which is that's the home. And in the home, we try to publish blogs every day, either in the morning or today was in the afternoon. The blogs basically touch on various key things that is going on in the market. So today, for example, we had the non-farm payroll, the jobs data, and things were happening with respect to the bond market. So I just put out a blog about what were the bonds telling us about the market, and kind of looking at interest rates, in particular 10-year treasury yields. We've had a lot of very, very interesting blogs since the point we went live. And one way to look at all the blogs is going to archive. But before I go there, also want to mention that while on the homepage you get to see the blogs, if you go to notes, these are shorter clips, and these we could be posting during the day if something interesting happens. And interesting enough, we talked about NVIDIA. This was an interesting note that the Magnificent Seven, as we know, is kind of how we call this rally that started since October, because these 7 stocks have done outstandingly well through the climb through October. However, over the month of January, out of the Magnificent Seven, first Tesla kind of started lagging, and then moving on to Apple and Google in February, and then finally Microsoft, Meta, and Amazon caught up, and then in the early March, and then this week we saw a huge upswing of NVIDIA, very close to $1,000, and then a very big reversal through the day, and we'll talk more about NVIDIA. But anyway, an interesting pattern, and we had talked about the projected target on NVIDIA over 900, and also talked about perhaps a reversal coming up in NVIDIA that can take it as low as 750. So we'll talk more when we look at that chart. Rohan posted a quick note about our video when it got published, the last week's video. And then we also talked quite a bit about Apple topping out. And this was when I had posted, this was early March. We really didn't know much about where it was headed, but turned out this double top in Apple, close to 198, panned out. We drew a channel with the upper and the bottom trend line. And when that break happened, we had said that at that break, knowing that it came on high volume, there's a potential for Apple, once it really breaks below 178, could go all the way down towards target closer towards 158. And we had said that Apple had started underperforming S&P 500 already from December, and that was clear in the in the ratio chart of Apple to S&P 500. We can see it declining since December. And also there was negative divergence in terms of the RSI at a lower high and MACD or PPO in this case at a lower high. And so it turned out that did happen for Apple. In fact, after it broke 178, it actually broke 170 and had gone down as low as 169. Reversed a little bit today, but overall, this was a great call that we had made. And again, it's just not so much of me alone. Others who are following charts also made similar kinds of analysis and similar kinds of predictions. And the key is, how do we make charts a lot of fun, and how do we make charts as a useful predictor of what's going on in the markets to kind of read the tea leaves? Interesting enough, another comment we had made was, this was going back last week, was looking at the options, and this is CBOE, you can see all the active options. there was interesting tea leaves to be read where S&P 500, which is SPY, was this is the ETF, was trading very heavy volume of puts at strikes way below the current price. So at 435, 460, and 410, going out till April 5th, you could see very heavy volume of put buying at these three strikes at 410, 460, and 435, 150,000 contracts, 75,000 contracts, and so on. So this was an indication that something interesting was going on in the market a week before, from now, last week, indicating that maybe smart money was setting up for some form of correction coming into March. And not just at the SPY, if you looked at, other kinds of indicators as well. This one didn't show that, but we had looked at VIX as well, and there was actually interesting options going on in VIX call buying, indicating that VIX would perhaps volatility would perhaps be spiking. So moving out of this, let's go back and now look at what happened in the market the full week. So let's do a quick overview of the market. Let me go back to the next screen. And so this is stockcharts.com. In the dashboard, you can actually go in and you can look at the market overview panel, and that kind of shows us today market was red across the board. So Dow closed 0.18, 1.18%. S&P was close to 2.65%. NASDAQ was a full 1% lower, 1.16. This is not NASDAQ 100, but the entire NASDAQ, with about 3,000 plus stocks, the New York Stock Exchange. So you can see red across the board in the markets today. Going into bonds, interesting enough, with the jobs data coming out, usually it's a market mover with respect to the bond market. Only the 30-year yield, which is a very long-term treasury, actually went up. Yield going up actually means that bonds are being sold off. The bond prices are coming down. And yields going lower means bonds are being bought. So the 30-year yield actually went up 4.26% is where it closed. 10-year yield closed below 4.1%, but the yield slightly went down. And then the 5-year yield closed below 0.4, just about 0.46%, 4.06%. And you can see that the TLT was actually slightly down, which is more of the 20-year plus bonds. And the dollar was slightly up, and we had an interesting blog about the dollar that I'll touch shortly. So going back now to, so this is the overall market of what happened. So that's from the equities, red across the board, bonds, mostly red, except the 30-year yield. Well, red actually here meant bullish, because red in yield means actually bullish for the bond, the price goes up. But only one part of the long treasury bond sold up slightly, where the yield went up from to 4.26. Commodities, interesting enough, we know this is a big week for gold, had a major breakout. So no question, gold actually closed higher yet again today, closed up 0.85%. GLD closing over a key 200 mark, closing at 201.6. Silver was actually slightly down. Copper, oil also. So commodities across the board were mostly down, except gold, and then natural gas was up by 10 cents, and corn was up by 12 cents. And the crypto market also had a very, very interesting week. We noticed that there was a very sharp drop of the cryptos from, this was actually just looking at yesterday's to today, but a lot of volatility is going on in general on the Bitcoin market in particular. So today, this is a 24/7 market, by the way. So the fact that it's showing $126 down is after 7 p.m. is is midnight in the GMT time. That's when the time clock changes to the next day. So this is basically going into Saturday's trade over Friday's trade. It's $126 down in the spot price of Bitcoin. Ethereum is up, XRP is up, is actually flat. Bitcoin Cash, Litecoin is slightly up, and so on. So the cryptos continue to get a lot of momentum, a lot of buying, and it was mostly green right now, as we see here. So let's go in and look at now from the overall market, from market overview, let's look at what happened from an industry perspective, which we call as an industry summary. Actually, before we do the industry summary, let me quickly show you a sector summary. So there are 11 sectors in S&P 500. Let's just look at that first. So this is 1 week. So we're looking at weekly performance. You see over the week. And interesting enough, this week positioned as the defensive sector closing in green. So you see that for the week, the utility sector, which is a very strong defensive sector, plays almost 3% plus dividend, closed at 3.29%. So that was the strongest performing ETF. So these are the 11, so call it sector spider ETFs of the sectors. So utilities performed the best. Next was the real estate sector fund, XLRE, which is also a defensive sector. And then the materials, which was commodities, and a lot of this is, helped by gold, closed up also quite strong for the week at 1.58%. Energy actually had a rebound this week, so it closed up over 1%. And the weakest performing sectors are actually, call it the offensives, or the sectors that are more into like in an offensive way, or where people are playing offense, or people are being aggressive into buying. So it turned out discretionary sector was the worst performer. And we know that a big part of the discretionary sector is Tesla. Tesla has been steadily coming down in the 170s, and that does impact the XLY. It's a big percentage of the XLY index. The technology sector, XLK, also had a drop. And as we know, Apple is a big part of the technology sector. It's in the hardware, computer hardware part of the technology sector. So that was the second worst performing sector this week. Communications is where Meta is, where Netflix is, where Google is, also had a negative week. And then we had kind of a flat on the healthcare, which is mostly large pharmas and United Health and insurance companies and hospitals. The industrial sector was kind of, went up 0.64%, financials 0.82%. So the top, again, as we noticed, was the defensive sectors, and on the bottom are the aggressive sectors that underperformed. So let's go and now look at from the sector view to the industry view. And the industry view basically breaks the sector a level down, and we can see across the industries, who did what for the week. So let's go in and look at the from the sector view. Let's look at the industry view. Yeah. So here, starting off from the top, this is again, we're looking at the last week's performance. Communication services, you notice these are the breakdown of the communication services. So we can notice that the media agencies were negative, down 1%. Broadcasting and entertainment was down 1% as well. Only part that did well is the fixed line telecommunications, like a Verizon. That tends to be defensive, by the way. So no wonder that did well in the communication services. The telcos, the Verizons, and the AT&Ts, those are defensive sectors. They pay dividends, and no wonder they did well this week. Internet did not do well, down 0.86%. As we know, in the internet follows Netflix, Google, and Meta. Publishing was also more of a defensive sector, was slightly up in green. And mobile telecommunications with T-Mobile and others was down 1%. Consumer discretionary is where, where Amazon is, where, automobile is, and so on. So we know that Tesla did quite poorly, and it was down 11% actually for this week. That's with the auto sector. GMs and Fords, they also fall under here. Auto parts was slightly up at 0.33. Specialized consumer services was up 1%. And if you scroll down, household products, durable household products, that tends to be, again, a little bit of a defensive sector, and that actually did well at 1.84%. Apparel retailers, Abercrombie Fitch, as you know, had been a huge parabolic climber. They fall under that, and they had a little bit of pullback as well. Bedline retailers, broadline retailers is also down. So overall, footwear, which is also a bit of a discretionary, where people, spend money, whether it's Nike or Foot Locker and others. So they had a decent drop this week as well. And home improvement retailers such as, Lowe's and Home Depot and others were also down 2%. So now, and in fact, toys, Mattel and others were also down 3% this week. So they had a bad week as well. Consumer staples, this is a defensive sector, so we see a lot more greens than red, so the respective industries in the staples. So personal products, brewers, food retailers, food products. The only one was general retailers, that was down 1%, and then soft drinks, where Coke and Pepsi are, was only down minus 0.11%. Energy, green across the board, whether it's oil equipment, integrated oil, exploration, production, pipeline, coal, you can see green across the board. So energy had a great week. And you can see that it's mostly over 1%, with 1.7% for all equipment and services. And integrated oil and gas was the lowest in that sector at it's up 0.6%. Financials also had a lot of green. They did quite well this week, except the financial administration, consumer finance, and specialty finance. The rest all were green and were mostly up. Some was even up as banks were up 3%, so banks had a great week. So going down to healthcare, it also tends to be a bit of a defensive sector, the pharmas in particular. So we can see that, and the biotechs have been doing quite well recently. So we can see the biotechs was up 0.42%, medical equipment was up 2%, and pharmas actually were down this week. So as you know, there's been a lot of news with Lilly and their weight loss drug, the GLP-1, and then with Novo and so on. So they took a little bit, maybe thanks, because Lilly has the largest weight in this pharma sector in terms of its market cap. It actually crossed 600 billion of market cap this week. And there was an interesting article about Lilly, though completely a different sector than Tesla, fighting that 600 billion market cap. Tesla went below 600 billion, while Lilly went up above 600 billion market cap. But at the end of the week, Lilly did have a pullback, and overall the pharma sector had a 1.44% pullback. Industrials have been quite strong. We know that it has been a very strong and steady climber. And in this week, we see a lot more greens in industrials. There's, as we know, the government is spending a lot of investment in the industrial sector, and that has helped the industrial sector quite a bit. And it has been strong. We see a lot more greens and a few reds, like the industrial suppliers. The airlines had pullback, and then the business support services. And then the trucking also had a 1% pullback, and the transportation services had a 1% pullback as well. Materials, as we can see, aluminum was green, had a very strong week, up over 7%. Commodity chemicals was up over 2.5%. Container and packaging was 2.3%. Overall, very strong week. But as you can see, the gold miners finally caught up. They were kind of lagging in the precious metal sector. The gold was more rallying than the miners, but the miners did have a very good week, up over 7.5%. And overall, materials did very well this week. Real estate is also the defensive sector, XLRE. These components are mostly green, not as big movement, except the diversified REITs that do pay dividends, and they did well, up 2%. The others were kind of mostly 0.5 to 0.7%. The residential REITs and the diversified REITs both, and the specialty REITs. So the REITs actually did a good week, closing from 1.6 up to 3.5%. Technology was actually got hit a bit, in terms of, we saw it was the bottom second from the weekly performance. And the biggest hit was computer hardware. And that's where Apple falls. And, that had a bad week. Software was the next worst sector. Semiconductors eked out a 2% gain, but a very interesting thing happened in terms of a key reversal in semiconductors this week. And we can look at the chart and look at the top 5 of the, one of the biggest ETF in semiconductors is SMH. And we look at the top 5 semiconductor stocks in that space and show what happened. Renewable energy, that's where the solar and others are, actually had a decent week, up 2%. Utilities tend to do very well as a defensive sector when the market is getting ready to pull back. And they had a strong week as well, with the gas distribution up over 3.4, multi-utilities at 3.75. So we actually had a blog talking about utilities setting up for a rally. We had published that late last week and turned out to be a good call there. Utilities had a very strong week. So let's move now into the next part of the analysis, which is, I want to show you, going back to our blogs, what's going on in general about the market. So a few weeks back, just when our blogs had come out, I had talked about the idea of reading the tea leaves from the bullish breadth indicator. And that was looking at the S&P 500, but in a similar way, you could start saying that about the bullish breadth indicator of the NASDAQ 100, which is BP NDX. The pattern here is something that says that as the market cycles back and forth, and these are the S&P 500, going up, coming down, going up, coming down, the bullish percent indicator also cycles. It goes through phases of red, where it's coming down, then phases of white, going up, red, white, red, white. So these cycles are kind of cycle indicators, intermediate term cycle indicators. So when to call for a market kind of getting closer towards an intermediate top. And as the red part of the phase of the pullback comes on the bullish percent index, which is a breadth indicator, you start preparing for a market correction. And that's when you see the S&P pull back. So we were talking about the part that, look, the MACD's histogram is almost converged close to zero and about to do a down cycle, like this, see the down cycle here from August through October. And as this down cycle plays out over March, April, we could expect to see an S&P pullback. So it turned out, while we had talked about this a couple of weeks back, it is panning out more as we head towards March. And interesting enough, there were a couple of very interesting mentions of S&P topping out and getting ready for pullback. One was in YouTube video. This is a weekly, they do, and twice or thrice a week by a couple of folks from the Fast Money, which is a very famous CNBC show that happens to 5 to 6 p.m. So there are three key people in Fast Money who participate in this. Dan Nathan is right here, Guy Adami, and then Carter. So Carter Braxworth. So these three folks do these weekly calls, and they call it Market Call. It's sponsored by FactSet. And in there, Carter drew a fascinating chart drawing a long-term trend line all the way from 1994. And in this case, he actually, in many cases, you could either use a log chart or a linear chart. Here he used a linear scale. So you can see from 1,000, 2,000, 3,000, and so on. And as he drew a line to the peaks, this is the March 2000 peak, then the January 2022, right before, like after the COVID, we had a very big rally with the liquidity from the Federal Reserves across the central banks across the world. And that rally led to a very, very sharp move from the bottom of the channel to the top of the channel. And you can see how fast that happened, right? From March to January. So this is a year, 9 or 10 months. We had this very sharp move, right? So this sharp move then led to the correction. This is the recent, cyclical bear market that we just went through. It bottomed out, and now from there, this bottom out happened in October 2022. We shot up by July. Then we had a pullback from July to October 2023, and then we had the next shoot up. And Carter's point here was, look, it's right at the top of the trend line. We might be closing to a top. It's not saying that we will immediately have a pullback from here to the bottom of this, which actually is rare because you need to have some major shock to have that kind of a movement. However, what he's saying is if you draw a line through the center, and so these are parallel lines, the top and the bottom. If you draw a line through the center, and he actually, if you watch the video, he actually draws it. So if you scroll further to the right, that's this line right there to the center. If you draw a line to the center, he's saying that potential possibility like we got during the bear market cycle in 2022 through January through October, we could get a similar kind of pullback. And now the trend line, the center trend line has risen, so it is now closer towards the 45 to 4600 level. So from these current levels near 5200, 5189 or 5190 is what S&P touched this week. We could be setting up for a pullback for the next several weeks or next couple of months towards that center line is what his call was. Interesting enough, on a separate analysis published by Larry Williams, he's a very famous technician. He's got a very famous Williams percentile indicator in his name, which is an oscillator that measures the market strength. He's a famous trader and also a great columnist. He writes and he creates videos, and he also has written books. So Larry Williams actually made a cycle prediction on the market. He does that. He publishes it quite often. And Jim Cramer shared it in his Mad Money show. So let's look at the video of that. I'm not going to play the video. We will share the YouTube link for folks to go and play it on your own. But what I will share is what was Jim showing in the analysis. This is what he was showing. So the red line is the cycle forecast by Larry Williams, and the black line in this particular case is the NASDAQ. And he shared it both for the S&P 500 and for the NASDAQ, which is not the NASDAQ 100, but the full NASDAQ index, the 3,000 stocks in it. So notice the cycle indicator for Larry Williams was we were going to hit a cycle peak around July of last year, 2023, and then we're going to be getting a pullback from there towards the October timeframe. And as you notice, this was a cycle indicator drawn in red using some technical and business cycles. He draws those cycles. Turned out that that's how the market played out, right? We did have a climb of the NASDAQ from the early part of spring of 2023 into a July peak. Then we got a pullback from July to October, just as the way the cycle had predicted. And then the cycle had predicted a very big move from here till sometime around March timeframe. He had drawn March 15th as a cycle peak. And it is pretty much playing out in that fashion. We are getting a pretty steep climb from the NASDAQ from the October lows to where we are now. And in the next week or so, it does not mean that it has to identically or exactly pan out by the cycle timing that he shows, but it's around that region. Around the month of March, he expects a cycle peak and then a pullback. And the pullback that he expects is going to play out over the next couple of months. Around late May is when he expects the cycle to bottom. So interesting that Larry Williams is looking for a pullback. Carter and Guy Adami and Dan Nathan are looking for it. And our analysis, the way we have been looking at it with respect to the BP SPX, as I showed you, tends to gel together. And hence the broader thinking is we should be preparing for such a pullback. So now, having covered some of the core things on the markets, I do want to take us back to the dashboard here and show you that if I look at the if I look at the post, this is the home page, and I look at my archives, you notice that there are several analyses in here where, in fact, just a couple of days back, you started talking about QQQ queuing up for a pullback. And if you look through it, there's a couple of interesting things I talked about. Seasonality of NVIDIA, if you pan that out over a 20-year time frame from 2005 to 2024, and that percentage here tells you out of the 20 years, what percentage of so there are 20 months, right? Of 20 Februaries, 20 Marches, 20 Aprils in that 20-year time frame. So it turns out almost 75% of the Februaries, like out of the 20 Februaries, like 3 out of 4 of the Februaries. So in this case, say 15 of the 20 Februaries, NVIDIA closed higher in February relative to January. Look across the months. And the reasons these months on the February, the May, the August, and the November tends to be strong for NVIDIA seasonally is NVIDIA's economic, its earnings cycle actually goes from January 31st to March 31st, April 30th to May 30th, April 30th, and then to July 31st, and so on. So you're a month off from the regular earnings cycles. So back, as a result, the months that NVIDIA announces earnings, which is February, May, August, and November, it tends to be very bullish. 75 to 80% of those months, it tends to be closes higher month over month, as in that month over the previous month. However, the seasonally weak part of NVIDIA is actually going into March and April. So this is something to think about, that perhaps this month and the next month could be a window of opportunity for NVIDIA to pull back, and for those who are looking to go long, to consider those as the months to look for a pullback. Then we talked about a bearish wedge forming on the daily chart, and had said that, look, there's a possibility that NVIDIA could perhaps be setting up for that pullback. And we also talked about that the QQQ was rising on this channel from the October lows, And while it had recently broken down that channel, we had thought that with the negative divergence of QQQ in terms of its RSI printing lower highs, and the fact that QQQ was also beginning to underperform the S&P over the last couple of months, that perhaps it was getting ready for a pullback. So we are also making a similar call with respect to perhaps there's a pullback coming in the QQQ. So going now to the semiconductors, which actually was the strongest sector in the technology over the last couple of months. And the reason the semiconductors have been this strong is because NVIDIA is actually the leader in that sector. So if you look at the S&P, the semiconductor holder, the SMH, this was the weekly chart that I had shared. It was also in one of the blogs. That's a classic cup and handle. So you have a cup between 156 down to 82, was October 2022 low. The high was at 160 of the end of the cup at around July of 2023. And after having formed the cup between 82 and 160, it formed a shallow handle to up to 130 or so, and then the breakout happened. If you measured the breakout, the difference between the top of the cup at 160 and the bottom of the cup at 82 is 78. Add 78 to 160 and you get 238. And that's exactly the cup and handle pattern that we had predicted, and it actually was met this week. SMH actually had a peak at 239 today and then pulled back sharply. And the kind of pullback it got was actually a very bearish looking pullback, and setting up in essence for in some ways you could call it setting up for a correction moving forward. So actually, if you look at today's close of SMH, it actually closed at 224.99. So it actually had a pullback. It touched 239, and during the day, from the peak at 239, it pulled back and closed near 225. So a $14 pullback. And this kind of a candle that you see on the chart is actually a very bearish pattern. It's a spinning. It's called a spinning top, or in the sense that the doji, it looks like just like you take a top in a spinning fashion. The opening and the closing price of the week are at part the same level, and then you have a wick on the top and in the bottom. So it's a spinning top doji is what the reversal pattern looks like. So coming back now to the individual components of SMH, so we can actually look at the various core holdings. So SMH, if you look at its market weight index, so NVIDIA has got the highest weighted in terms of 27% of the assets of NVIDIA. Second is TSM, close to 10%, 9.7. And AMD is the third largest holding in the SMH. AVGO or Broadcom is the fourth largest at 5.7, and ASML holding is at 5%. So if we take at the top 5 of the SMH and look at the individual charts, let's see what were their weekly patterns as we look through them. So let's go back. We already looked at NVIDIA. Now let's look at the second one, which is TSM. So let's look at TSM and look at what happened to TSM. Similar kind of a cup and handle between 57 and 109. That's adding, 109 to 57 is 52 points. Adding 52 to 109 is close to 161. It actually came pretty close to that. It came to 158. It didn't exactly touch 161, but it came to 158 this week. But it closed with a bearish looking candle. The bearish looking candle part again is because we can see that it had a long wick on the top. And when you have a long wick, as in during the week, especially today, it went quite a lot up to the top, but closed far away from the top. Means during the day, there was active selling going on, and it didn't manage to close towards the top of the week. When you have a candle like this with the top of the wick at 135, that's a bullish candle. When you have a candle like this, these hollow white candles where it starts the week at the bottom of the week and closes the top of the week, those are very bullish candles. And as you can notice with strong volumes, that means there's more pent-up demand for continued buying. And that's what happened, right? As TSM climbed, this was a bullish candle in the early part of January 2024. It went up with strong volume, pulled back slightly, went up again with strong volume, pulled back slightly. But today, it had a very different looking candle. This is similar to this kind of candle that you see in the early 2023. This is also a reversal candle that it touched 104 intra-week, and then it closed much lower that peak during the closer towards the $90 time frame value during that week. So that with a long wick on the top is a reversal, bearish reversal doji candle. In a similar fashion, we found a bearish reversal candle here. So you can expect at the next few weeks a pullback in TSM. And a typical pullback that happens when you get a correction is to come back and test its 20-week moving average, which is quite a bit lower from where it is currently. It closed at 146, the 20-week is at 114. It may not, there's no guarantees that it has to pull back there. There's definitely support near that previous peak at 135. So at the minimum, it will pull back towards 135, and if the correction of the market continues for the next few weeks till May, it wouldn't be surprised to see it pull back. The 20-week moving average will be climbing, by the way, because it's a lagging indicator. As the next few weeks, it will keep climbing to catch up to this high price that the stock saw. And it might be climbing up to closer towards 125 or 126 by the time the pullback comes. So it may not be exactly where it is today at 114. It'll be more closer towards the 125 level. And you can also see that 122 was a 120 to 122 was the previous resistance, where it went there and pulled back, went there, pulled back. So it's possible that the pullback of the TSM could pan out somewhere near 122. Going to the next chart of the SMH from the TSM was AMD. Similar kind of a cup and handle pattern in AMD. You see the 132 at the top of the cup, pull back to 54, 132 again at the top of the cup. So that's exactly $78 of move of AMD at 78 to 132. That measures to 210. It actually exceeded 210, went as high as 227. But look at where the candle for the week turned out to be. Again, a bearish reversal candle with a long wick. Similar kind of bearish reversal candles you'll find in other, like here at the 102 level. It kind of had a long wick and then a pullback. So AMD could be preparing for a pullback. Not sure how low it will go. As I said, 20-week moving average tends to be a place where it pulls back to, but that will be climbing. Currently it's 157. So by the time the pullback comes, this level of 165, which is previous resistance, can actually become strong support. So anywhere in the 165 and here I get 151, that level could turn out to be the level that it pulls back to. So I wouldn't be surprised to see a pullback in AMD towards the 150 to 165 level over the next few weeks. Now, going back now to the next semiconductor holder SMA chart, let's look at Broadcom, AVGO. So let's look at AVGO. This was actually the earnings. Broadcom had earnings yesterday, and it didn't, do very well after earnings. You can see that this actually started off as an outside candle. This week's candle was above the previous week's high, but then it had a very bearish engulfing nature. As in the candle for the week, the shaded red candle pretty much covered the entire white candle of last week. So this is actually another very bearish candle. Strong volume on the sell-off. It's a reversal, and it turned out that the AVGO's cup and handle in this case was not a symmetric cup. 642 on the left brim, touched 400, went up to 900. So this kind of a slanted cup. But if you subtract 400 to 900, that's about 500 points. At 500 to 900, it was 1400. This is where it went to. It touched 1438. So it met the target of 1400. And then after earnings yesterday, they had a very bearish pullback and closed actually down 6% for the week with heavy volume. So be prepared for a pullback in the Broadcom over the next few weeks, couple of months as well. And finally, the last stock in here, let's look at, I think it was AVGO and then ASML. ASML, in a very simple, interesting fashion, also has a cup and handle. 797 is the left cup, 357 is the bottom of the cup, 766 here. So 357 to 750 is about 410 points. At 410 points to 766, that's closer to 1170. It did not reach 1170, but it came close. It reached 1056 was the high of this week. Look at, again, a classic reversal candle for ASML this week. This is, in fact, a doji. where it opened and closed the week at about the same level. It opened the week near 992, it closed the week at 994. So when you have a candle with open and the close is at similar levels, it's called a doji. And in this case, also spinning top kind of a candle, where the long wick on the top and the shorter wick on the bottom. So again, sign of a pullback, the sign of a topping formation. So summing it up, I think we should be prepared for a movement in the downward direction of the markets over the next several weeks. Next week is key. We do have CPI on Tuesday, and then we have FOMC with Powell doing a press conference after the FOMC meeting on Wednesday at 2 o'clock. The announcement is at 2 o'clock, the press conference is at 2:30. So next week will be an interesting, volatile week, and there's a possibility that any signs of continued inflationary pressures, you know, we had a very strong January inflation that came out on February 13th. So if the March 12th, which is the February inflation coming out on March 12th, shows any continued heat, as in the inflation staying strong, market will not like it. It means the expectations for interest rates will actually be taken aback. Market is expecting still about 4 cuts. That might not be the case if inflation continues to be strong, because the Federal Reserve is watching that as well. And that could mean that they may still cut, but they may be moving out now. Initially, market was expecting a March cut. That got pushed out to June. And now we are expecting, if the inflation is strong next week, the cut could now be pushed out to September or later. And that could mean the market may not like it and could get a deeper correction. So with that, thanks again, and look forward to a session again next week.